JPMorgan Chase remains one of the highest quality banking franchises in the world. Its enormous scale, diversified revenue streams, strong capital position, growing wealth management business, powerful investment banking franchise, and consistent shareholder returns make it one of the strongest long-term financial stocks. However, JPM is no longer a cheap bank stock. With the shares trading around the mid-$350s, investors are already paying a premium for the company's superior profitability. My 2026-2027 framework is a $375 to $420 base case, $450 to $500 bull case, and $285 to $315 bear case. JPMorgan is much more than a traditional commercial bank. The company operates through consumer and community banking, corporate and investment banking, asset and wealth management, and its enormous payments businesses. This diversification is a major competitive advantage because weakness in one segment can be offset by strength in another. JPM's first quarter 2026 results demonstrated this strength. With approximately $50.5 billion of managed revenue, $16.5 billion of net income, $5.94 of earnings per share, and approximately 23% ROTCE. Net interest income remains one of the most important drivers for JPM. The company has been targeting approximately $95 billion of 2026 net interest income excluding markets and approximately $104.5 billion including markets. While lower interest rates can create pressure on bank margins, JPM can offset some of that pressure through loan growth, deposits, credit cards, payments, investment banking, markets, and wealth management. My 2026 EPS framework is approximately $22 to $23 in the bear case, $25 to $26 in the base case, and $27 to $29 in the bull case. One of JPM's biggest growth engines is its corporate and investment bank. Markets revenue reached approximately $11.6 billion in the first quarter of 2026, representing strong year-over-year growth. If M&A activity, IPOs, corporate debt issuance, trading activity, AI infrastructure spending, and corporate investment remain strong, JPM could continue benefiting from its enormous global franchise. This is one reason JPM deserves a premium valuation compared with weaker regional banks. JPM's Asset and Wealth Management division provides another powerful long-term growth engine. The business had approximately $4.8 trillion of assets under management and approximately $7.1 trillion of client assets in the first quarter of 2026. As global financial wealth increases, JPM can generate additional recurring revenue through asset management fees, private banking, brokerage services, wealth management products, and lending. This business is strategically important because it can grow without requiring the same balance sheet intensity as traditional lending. JPM's balance sheet is one of its greatest competitive advantages. The company has approximately $4.9 trillion of assets, around $364 billion of stockholders' equity, roughly $291 billion of CET1 capital, and a standardized CET1 ratio around 14.3%. JPM also has an enormous deposit base and loan portfolio. This scale and capital strength give the bank significantly more ability to absorb economic stress than many smaller competitors. The biggest risk to the JPM investment thesis is the credit cycle. The bank has significant exposure to credit cards, consumer loans, commercial real estate, corporate lending, and leveraged finance. If unemployment rises sharply or the U.S. economy enters a recession, credit card and commercial loan losses could increase substantially. However, JPM's enormous capital base provides a major buffer. The bigger shareholder risk would be a combination of rising credit losses, falling earnings, and simultaneous valuation compression. JPM is also becoming increasingly attractive as a capital return story. The company announced plans to increase its quarterly dividend from $1.50 to $1.65 per share, beginning with the third quarter of 2026, subject to board approval. JPM also authorized a new $50 billion common share repurchase program. Dividend growth combined with buybacks can meaningfully increase long-term shareholder returns, even if the stock's valuation multiple remains relatively stable. The biggest question is valuation. JPM is trading at a significant premium to book value compared with ordinary banks. However, JPM's profitability justifies part of that premium. The company has demonstrated the ability to generate very high returns on equity and tangible common equity. If JPM can sustain high teens ROE and strong capital efficiency, a premium valuation can remain justified. But if profitability falls toward the low teens, the current valuation would become much harder to defend. Wall Street remains generally positive on JPM. Recent analyst targets have included approximately $420 from Bank of America and Barclays, $400 from UBS, $390 from Wells Fargo, $384 from KBW, and lower targets around $360 to $370 from several other firms. The broader analyst range is roughly $305 on the low end to $420 on the high end. This suggests that JPM is widely viewed as a high-quality bank, but expectations are already relatively strong. My bear case assumes a meaningful deterioration in the macroeconomic environment. A recession, rising unemployment, higher credit card losses, commercial loan problems, weaker investment banking, and lower net interest income could reduce JPM's earnings. If investors simultaneously reduce the valuation multiple toward approximately 12 to 13 times earnings, the stock could potentially fall toward the $285 to $315 range. This is a stress scenario rather than my primary expectation. My base case assumes the U.S. economy avoids a deep recession, loan growth remains healthy, net interest income stays resilient, investment banking improves, wealth management continues expanding, and credit losses remain manageable. Under this scenario, JPM could maintain high returns on capital while continuing dividends and share repurchases. I believe a $375 to $420 range is reasonable for the 2027 period, with $400 or higher becoming achievable if earnings continue to compound. The bull case requires JPM to demonstrate that its long-term earnings power is substantially higher than the market currently expects. A strong U.S. economy, healthy M&A activity, strong markets revenue, continued AI and infrastructure financing, accelerating wealth management growth, controlled credit costs, and aggressive capital returns could push EPS toward the high $20 range. If investors continue assigning JPM a premium multiple of roughly 16 to 17 times earnings, the stock could reach $450 to $500. With JPM trading around the mid-dollar 350s, the first important resistance zone is approximately $366 to $370, followed by $400 and then $420. On the downside, I would watch $340 to $345 as the first support area, followed by $320 to $325, with $300 to $305 representing a major support zone. A deeper economic shock could potentially bring the stock toward the $280 to $285 area. JPM's 2027 Investor Day could become an important catalyst for the stock. Management's long-term strategy, capital allocation plans, earnings growth targets, technology investments, and expectations for the company's various businesses could influence how investors value JPM. If management demonstrates that high returns on capital can be sustained while the company continues investing heavily for future growth, the market could maintain or even expand JPM's premium valuation. My overall view is buy, hold for the long term. JPMorgan is one of the strongest banking franchises globally, with exceptional scale, a powerful investment banking operation, a huge deposit base, growing wealth management, strong capital, dividend growth, and substantial buybacks. The main concern is valuation rather than business quality. At around the mid-$350s, I would not call JPM a screaming bargain, but a meaningful correction toward $320 to $330 without fundamental deterioration would make the risk or reward considerably more attractive. My final framework is bear case, $285 to $315. Base case, $375 to $420, and bull case, $450 to $500. The central thesis is that JPM does not need explosive growth to generate attractive shareholder returns. Continued earnings growth, dividend increases, share repurchases, and high returns on capital can compound value over time. For 2026-2027, I view JPM as a high-quality compounder rather than a deeply undervalued bank, with approximately $400 to $420 representing my strongest realistic upside zone, and $450 to $500 representing the more aggressive bull case.